Hi, let's talk about Bitfarms. It's a blockchain infrastructure company that mines for cryptocurrency coins and tokens in North America. The market cap of the company reaching 700 million, and full information should not consider investment advice. As we can see, the revenue grew by almost 7% over the past year, and yeah, simple Wall Street shows that risks are that the shareholders have been substantially diluted in the past year, and it has volatile share price, and also insiders sold the stock in the past. So as we can see here on the returns, so it pretty much made a lot of returns since the expansion that they had last year, also private placement, and also one of the uh, expansion in lately. So announcer double instant. So yeah, they increased the capacity, and yeah, the huge returns that they have is pretty much of the expansion that they had. So 1 year return of 1000%. Of course, those numbers are beating the industry in the market. Long-term price volatility considers lower than the industry's and average market volatility. On the valuation side, unfortunately, simple Wall Street does not have price targets, but TipRanks does. It's actually $6.52 currently, so there's 21% upside, and yeah, same as the 12-month forecast. And also Market Watch has near the same 6.34. Yeah, the current price is 5.35 at the close yesterday. And let's have a look at the future growth. Here's the software industry. It's 13%. Unfortunately, there's not for the company, but the earnings per share growth is forecasted, or actually is not forecasted, actually is actual, because they have EPS on a negative side. So it's the company is unprofitable. They were profitable 2 years ago, December 2019, and also March, based on their earnings updates. But currently the latest here is December 31st. Past performance last year, earning growth decreased by 664. So the company is unprofitable. Let's look on the financial health side. The equity is decreasing, the debt level increased a little bit, and yeah, currently it's not a good situation where the debt to equity ratio is over 100%. So less equity, more depth. And do they have cash? They have been raising the cash. Oh yeah, almost 6 million. So balance sheet, this is pretty risky stuff. If the interest rates go up, this could be bothering the company. They could put more shares outstanding to increase the cash level, to lower the depth, but then the shareholders are getting less in percentages. Dividends, they're not paying dividends, and insider volumes. So yeah, there's actually on both sides. So I think more of the sellers. So there's individuals that have been buying the stock. This is quite kindly odd movement, or I maybe understand. So he brought the stock at max price 493 and sold it at 5. So is this some kind of a trading? But here's mostly individuals that have been selling and buying. Here's actually on the both sides. And yeah, ownership breakdown: general public holding almost 80%, insiders 16, institutions almost 5. And here's the top shareholders. So I see here pretty much individuals and morphy that have been decreasing the stock uh, almost 21%. And of course the latest, it's not so actually, last reporting holding date 7th of April, somewhere 31st of March. Yeah, there's on the institutions last year's last reporting holding date. So this is not so fresh as it could be. Simple safe dividends shows that shares outstanding keep increasing. Total sales decreased within compared to a few years ago. And investing.com summing the stock for long-term investors as a strong buy. But yeah, so actually we see in this section of video I could answer some of the questions that have been recently you guys are commenting. So there's a Billy Horn asking me, would you invest in this today? So usually I'm not investing in kind of volatile share price because if you see the movement, so if there's huge returns over 1000%, it could go possibly very fast down and it could hurt. So if I would prefer to invest in some of the stock that I research, I most probably load up within 1% max. And yeah, I answer it. For me, it's too risky. I'm trying to build my portfolio with quality company first. Then there's another gentleman, the Bard. Farmmi is quality. Your idea of quality sounds mainstream. Don't even tell me what companies you consider to be quality. So yeah, the criteria for the quality companies are, in my view and in my perspective, is that the company is listed. Yeah, of course, they're included in S&P 500. There's a lot of like companies with huge depth. They are cutting the dividend payouts. They have huge problems, lawsuit and so on. So everybody knows, but they're most probably more stable than some of the stocks I research. There are, for example, we can uh, add a new company, for example, United Health. So let's add one company, for example, cost per share of 400, and yeah, just have a quick look. So dividend safety 99, the best score, very safe dividends that they're paying. Dividend yield is currently 1.25. So I think if you could borrow the stock last year's March, so they pick up, I think 2.2 or something were the highest point when the stock market crashed. And look what I mean by quality stocks. So this is, I think this were like all the time there's same criteria as before. Earnings per share are growing every year. Uh, Free cash flow per share is growing. Shares outstanding decreasing, so they are buying back the stocks. Total sales are decreasing. So when you see shares outstanding decreases, total sales are increasing, that is the quality company. Return on equity 26%, so this is going up as well. Operating margin, okay, it increased by 1%, but it's not significant. Free cash flow margin 8%. So there's a lot of fundamental calculations here that showing that the price is very good, and they're actually, like, if you see like 52-week price range 400, so they're almost all time at the highest. So whenever you are picking the stock, you could possibly buy even at the highest point. So I actually brought the stock when it went, I remember 300 point something. I brought the stock, and now it's $100 expensive than I bought it. And there's also the dividend growth. Yeah, one more of to the criteria for the quality stocks. So they are paying quarterly. You know, the dividend, the ex-dividend day, payday, and they are increasing as well. So you can see here that they start in 2009, and they raised every year since then. Last 20 years, 41% per year. So they raised the dividends. Latest in June, 16%, which is considered as well as very fast. Last 5 years, 21%, very fast. And so if we compare to the Farmmi that you're arguing its quality, Farmmi, or what? Okay. So let's have a look. For example, 101. Let's have a closer look. So shares outstanding almost doubled. What does it mean? If you earned one like 1%, and if they add some more stock, so your 1% turns in 0.5%. That does not mean good for the investors. It does mean in some ways good for the company, because they are raising here money to expand. But if the expansion would be going not so well, they could not go well. So let's have a closer look in this one. Yeah, so there is, I'm sure there's buyers that brought the stock at a level of $2 per share, then it decreases to 0.36, lowest point 0.30. So this is pretty dramatic drop compared for example, United Health. So they raised all the time. There's a volatility, but there's long-term uptrend. And I remember I was buying somewhere around last year, July, 300. Now it's up to 400. I know there could be correction or so on, but I'm not saying that this is not so quality. So it's less quality than the bigger stocks. Yeah, I hope I answered the questions. Thanks for watching this video. Subscribe to the channel, like the video, and see you in the future one.